Good morning and welcome to another edition of the Weekly Market Note with Main Management. This is for June 20th, 2025. Hope you had a nice weekend. We'll dive right into it. On the performance side, as usual, the trailing week is at the bottom, and you can see mostly red across the board. Big news was kind of Israel and Iran continuing to exchange missiles. The U.S. went in over the weekend and dropped some bunker buster bombs, apparently. It's kind of TBD on whether or how effective that was, but markets are kind of, a little bit down, a little bit up.
Playing the geopolitical kind of classic risk-off play across the board, and then having energy and oil prices kind of spiking off that news. Not as much as I think was anticipated or potentially feared. But still, as you saw in the last week, this was even before the weekend activities, oil prices were up. And as a result, energy as a sector was also up on the weekend.
Yeah, it was the lone positive sector, up 2.8%, and then healthcare down the most at 3.1%, despite its kind of traditional defensive positioning. But it's really kind of had a hard time getting out of its own way this year. On the recession dashboard, not a ton has changed here. A lot of sideways. Currently evaluating these, on an ongoing basis. We'll touch on the housing data that we got recently in the coming slides. But the big news kind of the week as well was the FOMC met. They kept rates unchanged. The median dot plot still shows 50 basis points of cuts forecasted for 2025, which is 2 25 basis point cuts. I think the timing is September and December now.
That's the best guess, I think.
Although you're kind of seeing some dispersion in the members, in the voting members. Some are coming saying they are more hawkish, others are more dovish, saying we could see a cut sooner. But overall, the summary of economic projections kind of was a little bit more negative from March. The GDP was revised down, unemployment rate revised up, PCE revised up. So you're kind of seeing some deterioration in the way people are looking at this.
A couple thoughts on this. On the median dot part on the left, you can kind of see how almost half of the members are at that top bar, basically showing that they want no, or they think there's going to be no cuts for the rest of the year. Versus, and then there's another kind of half,
kind of a barbell
of the committee that thinks there's going to be two. So it's either you think there's going to be none, or you think there's going to be two. That's kind of the two camps that a lot of the voting members are in. And then on the summary of economic projections. So as a reminder, this is a release that they have quarterly, where essentially they go to all these different members of the FOMC and the Fed and say, hey, what do you think? What's your projection for these different economic variables? And then they ask them different questions like, what are the risks to the upside and the downside? And you can see relative to March, the last quarter, they had this survey. GDP kind of forecasts went down, showing they're more kind of worried about the economy, as well as the unemployment rate ticked up slightly for both 2025 and 2026. And inflation also ticked up for 2025 and 2026. So I think that when you think about how they kind of calculate the Fed funds rate, there's obviously the worries about the unemployment rate on one hand, and then the worries about inflation on the other. I think the fact that they didn't really change their estimates for cuts, at least for 2025, shows that the higher unemployment kind of offsets the higher inflation, where they're worried they're worried about unemployment, but they're also worried about inflation. That kind of freezes them in this, well, I guess we're just going to do what we said we'll do in March. So I think that's something to watch there.
Yeah, certainly. Moving forward, we've talked about the budget, and then with the big, beautiful bill kind of still up for debate, there's been a lot of discussion around the deficit that the government continues to run at. You can see the chart at the bottom there. The red is a deficit and surplus. And really, April's the only month that posts a surplus, and that's because it coincides. That's when taxes are due. Beyond that, the government is, as we say, it has a spending problem, not a revenue problem. We'll see how this bill, if it gets reconciled, or if it gets modified as we move forward. And in the meantime, one kind of positive from the taxes is they are certainly bringing in a lot more money than they have in the past. But again, that's not the way that's going to fix. That's not what's going to fix this deficit.
Even if you had like the most largest tariffs imaginable, that's still a relatively small amount compared to the deficit. You need to like have I haven't seen the latest estimates, but you basically need to have a huge tariff amount to really make up for the actual deficits. And even with the current rate that are higher than a lot of people expected, it's still, I think, like 10% is something like the estimate.
And these pieces that they're kind of trying to put together to make total up to the deficit, whether it's being I think there's another provision where they're talking about selling public land. They're putting tariffs on. It's like these even combined get nowhere close.
Or Doge.
Exactly. So you kind of see that it's really the spending problem. It's not a matter of drumming up more revenues.
Yeah, exactly.
Which nobody wants to cut. So we'll see. We'll see what happens. On the macro side, we got retail sales, which were down 0.9% month over month. The second down month in a row. Core were down 0.1%. A big reason behind this is kind of a drop in autos, which really were pulled forward into February and March. I saw something on that JP Morgan was mentioning that they've really not seen a deterioration in auto demand in particular, that it's just more of a timing thing. So as far as kind of the weak retail sales go, I think this is hopefully more of a timing issue and less of a demand softening.
Yeah, the trend is still somewhat positive. If you look at the other kind of X autos or the control group, not too bad. I think there's like on a longer term, 6 month, 3 month trend, they're still somewhat positive. There's obviously a lot of noise from the pull forward of autos and pull forward of these purchases due to the tariffs. So it's kind of going to take some time to sift through that noise to figure out what the actual.
You might get some volatility in the readings on a month by month basis.
Yep, exactly.
Yeah. And on the category basis, we saw miscellaneous stores and sporting goods up the most month over month, while automobiles, as we mentioned, and then building materials and garden equipment were down on a year over year basis. Furniture and non-store, so that's mostly online, are up big. And department stores and gas stations are down the most. And again, gas stations, that's both, that's a lot of pricing issues, not necessarily demand indicating. It's more of a pricing because they do it on a dollar basis. But those are down 7% year over year. On industrial production, this again was also kind of muted. It was down 0.2% month over month in May, below forecasts for a 0.1% rise, while manufacturing output was up 0.1, but did miss as well. Here, the 6 month averages, as we mentioned, have been kind of chugging along solid, and hopefully we'll kind of see a resumption of that uptrend. But as you can see, that 6 month average has just been kind of along the zero level. So, these kind of muddle along. They're up 0.6%, both of them on a year over year basis. And again, just kind of trending sideways, not a ton to see here. The capacity has been declining. That was down to 77.4% capacity utilization. Manufacturing was unchanged at 76.7%. Part of this is efficiencies, where if you have more efficient machines that can do more in the same space or do more in less time, then that's capacity that maybe you had at one point that is not being utilized, even if your output is the same. So that's why they look at both production capacity and manufacturing output. And then on the right, as you can see here, the high-tech components continue to be up solid year over year. And no surprise there, given the kind of semis.
Data center.
Demand for high-tech components is strong. We did also look at, we didn't post this, but we looked at the defense sector as well. And you might have thought there'd be some increase. And I guess maybe we'll see that. There wasn't yet, so maybe we'll see that over the summer as kind of Israel and Iran continue to play out. But maybe something to look forward to. I guess I don't know if we look forward to that. To anticipate. We also got import and export prices. Again, this has been kind of in the news more than usual due to the tariffs. One key thing to remember here is that these are measured before tariffs, so it's actual goods prices as opposed to kind of artificially inflated due to tariffs that don't necessarily reflect the cost of the goods in there. But they were import prices were flat, and then export prices fell 0.9%. And if you exclude fuels, import prices were up 0.3%. So you are seeing a bit of a rise in import prices here, with gains in every major category outside of food. But this data, again, it's up moderately, but not huge. I think is kind of the key takeaway here.
Yeah, it's because it's pre-tariff. You're probably not going to see huge impacts. If anything, maybe there's going to be some discounts before the tariffs, like as a way to offset those. But yeah, it wouldn't show up in something like this.
Yeah. Then, moving over to the housing market, this continues just to be tough. The high mortgage rates are really weighing on people. High prices, The NAHB housing market index was down again. That's 4 out of the last 5 months. It's been down. It's fell to 32 for the headline level, which is the lowest since December of 22. All the other sub indices are down, and it's interesting. Single family sales dropped all the way to 35, which is the lowest since 2012.
Wow.
So stuff here is really, really depressed. And you can see it's more than just the kind of COVID spike. This is more systematic.
Yep.
And I think you really have to hopefully see some sort of relief in rates.
Yep.
But again, with the Fed kind of on pause, it's not in sight.
It's going to take the rates to move a lot, which what is going to move rates? It's very unclear. There's not much like light at the end of the tunnel, so to speak.
Yeah, and you got existing home data that was out today. That again, they're just kind of depressed.
Yep.
They moved up a little bit, but it's not. And prices remain elevated, so it's a tough market for people buying. You really have to kind of have a big reason to move and to kind of bite the bullet and take on a 7% mortgage. On the hard data outside of the sentiment, as we mentioned, starts and permits were both down in May. Again, this is just kind of can't get out of its own way. It's similar story. We're not really seeing much relief. You kind of saw some grinding higher a little bit, but again, they kind of turned back down and have just moved back lower.
No one's buying homes. No one's starting homes. No one's getting the permits to build homes. It's just overall frozen in place.
Yeah. Inventories were up to multi-year highs as kind of people are just sitting on the sidelines hoping for some relief. And, if you're selling your home, it's like, why would I ask for, give anybody a deal here? It's going to be a make me move price. So you're going to ask for a high price here. So that's kind of feeding through into the demand side as well, very obviously. So in summary, FOMC kept rates unchanged as expected, still forecasting 2, but you are seeing a bit of a bifurcation in the voting members. The government deficit is running unchecked. Tariffs are, maybe, I don't know, a drop in the bucket. Yeah. Retail sales, kind of the macro data was pretty lackluster this week. Retail sales, industrial production, housing market, all just kind of meh. Yeah. Nothing much to see there. And then this coming week, or this week now, as we're recording it, we mentioned existing home sales, but we also get the final reading for GDP for Q1. And the big piece, the more kind of relevant one, is probably Core PCE and the consumer spending and income data that we get on Friday.
Yeah.
That's kind of it. Thanks for joining us again, and hope you had a great weekend and a good start to your week.
Great. Thanks.